about current liabilities. So current liabilities, just like current assets, it's something that's going to happen within a year, right? You're going to change it to cash or use it up within a year, or the operating cycle, whichever's longer. But again, we're not dealing with operating cycle, remember? So current liabilities are obligations the company is going to pay within the next year. So these are things that you're going to pay off within the next year, all right? Common examples might be things like accounts payable, salaries and wages payable, notes payable if the due date is within the year, or if it says notes payable current, interest payable, and income taxes payable. You can also have something called current maturities of long-term obligations. And what this is, and you're not going to have to do this at all. You won't see this either in your problems, but just so you're aware, is that companies will move over the amount of money from long-term long-term debt, like say mortgage, that they're going to pay in the current year. And the reason why they do that is it gives a more accurate picture of the health of the company. Because if you were to look at a company's current liabilities and say you looked at their current assets and you're like, oh, okay, they have $5 million. And then you look at their current liabilities and you're like, oh, they only owe $1 million. Wow, okay, so they're in good shape. They have $5 million, they only owe $1 million, right? Well, if they haven't moved over their mortgage, then yeah, it looks great. But then if you look at the mortgage and figure out how much they're going to pay in that year, they might be paying $6 million in mortgage that year. So now you've got a company that is going to be they don't have enough assets to cover their liabilities that are upcoming. So it doesn't mean they won't have that money. It just puts them in a more difficult financial situation, and it changes their ratios of their financial health. So companies will do an entry at the beginning of the year to move over the amount of money from long-term liabilities into short-term liabilities that they're going to be paying off in that year. You don't need to remember that. That's just an FYI that you're aware. You won't have any problems that have that. Okay, so here's just kind of showing the current liability section for a company. It's got the accounts payable. We've got short-term debt. We've got accrued compensation and benefits. You're not going to see anything labeled that. Accrued expenses and other liabilities. You're not going to see anything labeled that. Income taxes payable. And then the total current liabilities. The next section is the long-term liabilities. So just like the long-term investments, long-term liabilities are longer than a year. So these are liabilities or obligations that the company has to pay after 1 year. So they're not going to pay it off. It'll be longer than a year. It could be 2 years, 5 years, 6 years, 12 years, just longer than a year. Okay. So these could be things such as bonds payable, mortgage payable, long-term notes payable, leases liabilities, pension liabilities, things of that nature. Okay. And this is kind of showing you a financial statement here for Nike company. You might see bonds payable, but you're not going to see deferred income taxes and other. You're not going to see anything with that title. Okay. And then the stockholders' equity section, it's the same as it was when we did chapter 1. For the balance sheet, you have common stock listed first. Those are investments of assets into the business by stockholders. And then you have retained earnings, which is what you figured out from your income statement, you know, what you have retained for use in the business after you've paid all your expenses. Okay, so this is in our book. So we're going to do this one together. Match each of the items to its proper balance sheet classification below. If the item would not appear on a balance sheet, use NA. And so let's see. Salaries and wages payable. Actually, you know what? This one's in the book. So hold on a second. I'm not going to put that on there. Okay.